Ladies and gentlemen, it is a pleasure to have this keynote speech here today on a subject which could actually have the farthest reaching implications on European bond markets in many, many years. Now, we're obviously all getting used to these new virtual formats, and believe me, I would have preferred to have this presentation in person at the event. I think it was scheduled for Barcelona this year. Of course, this is not possible. At least I want to keep you engaged, so keep your attention without being able to look into your eyes. And therefore, we'll just show you or run you through a few slides on the EU's debt plans, and then have a follow-up with a Q&A where a colleague will ask me some questions, or the most frequently asked questions actually that we have received on the EU debt plans. Now, this is the agenda. First of all, I want to illustrate what the EU is actually planning in terms of funding for the corona crisis. Second, what are the implications for its member states, the EU sovereigns? And third, then address some of the open questions on this project. So let's start with an overview of the different elements of the EU corona funding plans. First of all, there is the unemployment support scheme SURE with a size of some 100 billion, of which already some close to 90 billion have been endorsed by the EU Commission. And here funding is actually expected to begin as early as this September, because unlike the other big program from the EU, this is backed by guarantees from the member states, not by the budget itself. And so we expect actually some 30 billion to be already issued for this program as early as 2020, so this year. The second element then is the cornerstone of the EU recovery package, the so-called Next Generation EU Recovery Fund. The size is supposed to be up to 750 billion, consisting of 390 billion in grants and 360 billion in loans to the member states. Issuance here expected to begin at the start of next year and be completed then over the next 4 to 5 years. The third element then comes from the ESM, the European Stability Mechanism, and here the total size of the available credit lines to the euro area member states is some 240 billion. And then last not least, we have the EIB, the European Investment Bank, which has a number of different programs up and running to support the economy, quite sizable. However, important, especially for capital markets, is that a lot of this comes in the form of guarantees and therefore will actually not be directly funding relevant. Now, let's take a closer look at the actual numbers. Here in this chart, on the left, you see the outstanding debt that the EU has in its legacy program so far today, the yellow part. And then the right-hand column for the EU shows you the potential maximum amount of outstanding once all the corona funding has been completed. However, as these gray areas show, we only expect part of this funding to be actually drawn. We need to keep in mind that in particular the loan part of the programs will probably not be used by a number of countries that are actually enjoying more favorable funding conditions than the EU itself. On the right-hand side, then, the same exercise for the ESM, and here we expect only actually a small fraction of the 240 billion credit line to be drawn. Besides the more favorable funding opportunities that a number of countries have in the markets themselves. Also, a number of countries appear to be rather hesitant to tap the ESM, the so-called bailout fund, also for stigma reasons and as they are worried about the conditions that could be attached but are actually quite minor when it comes to the pandemic credit lines. Then the question about timing. When will the EU come to the market? I already mentioned that we expect the first issuance in September and some 30 billion during the remainder of this year. Then for the next 3 to 4 years, we're expecting a EU payout and EU funding in turn of around 150 to 170 billion euro per year. Looking at how long it has usually taken the EU from actually making these commitments to the actual payouts, it becomes clear that even though the EU wants to front load a lot of its funding and the aid payments, there will be some delays, and this is why this will be stretched out over a period of the next 4 years. Now, how do these volumes of the EU compare with other established issuers in the European bond markets? Here on the left-hand side, we do see basically the expected gross bond issuance by EU sovereigns in 2021, and you can see that actually the EU is close to the at least Spain, and certainly will become a significant issuer in the European bond markets next year. If you just look at net issuance, actually, as the EU does not have any refinancing or very little refinancing to do, the volumes are still much, much larger, actually, and the EU will be the largest net issuer in all of Europe during the next few years. So this is the gross bond issuance that you see here on the left-hand side. When it comes, however, to the outstanding debt that the EU will eventually have, I mentioned 750 billion is what we expect over the next 4 years. Then in the end, you see that the EU is still small compared to the others. So the debt markets in certainly Germany, France, and Italy, but also Spain, are significantly larger than the eventual outstanding volumes that the EU will have. How does the EU compare to its peers, to its supra-peers? Well, here, no doubt, with 750 billion outstanding after 4 to 5 years, it will be by far the largest supra issuer out there, with significantly larger volumes than the second largest then in place, the EIB, or also the EFSF and the ESM. So much now on basically what the EU will need to fund. Now let's have a look at actually how the money will be spent, or what will be the impact actually on the member states, on the sovereigns that are receiving the money. Well, if you calculate the payments that each member state will receive via the various programs, be it grants from NGEU, loans, or the SURE program, or the ESM, or also an interest rate subsidy, of course, that a lot of countries receive by funding through the EU, well, we come up with quite some sizable numbers, especially for Italy, that will be the largest recipient of some 250 billion, followed by Spain and Greece. So definitely there will be a lot of flow or funding support from the EU, especially for these peripheral states over the coming years. Now, the other question then, of course, is how do these EU support mechanisms actually help the member states when it comes to reducing their debt burdens? Well, and here you can see the impact relative to GDP of the debt ratios of the member states that they will largely receive from grants and then also to a certain degree from the rate subsidies. And here, yes, the numbers are also sizable, especially for Greece and Eastern European states. But if you look at Italy, for instance, if the debt burden of Italy is reduced by some 5 percentage points, it helps. But of course, we're talking about a debt to GDP ratio of close to 160% of GDP by the end of this year. So therefore, the debt relief compared to the outstanding debt will still be fairly marginal. What we've also done then is we've basically drawn a line through all the rescue support from the EU. We've then added the support that the member states will be getting from the ECB bond purchases and compared basically these with the funding requirements that the sovereigns are facing over the next few years. And here it is really very striking that, of course, depending on some assumptions about the ECB purchases and also how many of these loans will be drawn, that if you look at Italy, we will be left with significantly negative net issuance, especially during the upcoming year. So in other words, the EU funding support for Italy plus the ECB bond purchases will crowd out existing investors in the Italian bond markets to the tune of some 100 billion euros next year. So definitely this underscores that the combined support mechanisms, at least on the flow side, will be very favorable, especially for the periphery countries and here Italy. Now, we also need to take a step back from just these pure numbers that I have shown you when trying to assess the implications, the further implications actually for the bond markets. And here, what is definitely very important for the fixed income markets is the political signal. For the first time in many, many years, actually, both Germany as well as France are together trying to establish common debt issuance in Europe. And this is definitely a very strong political signal for the markets. And if you look at the initial assessment of the rating agencies, actually it seems that even though EU debt will increase by large multiples, that the credit assessment from the rating agencies is more favorable because of this strong political signal. For instance, S&P is calling this a major step forward for the strengthening of the political cohesion by the EU member states, and thus has already upgraded the outlook, the AA rated outlook for the EU, and an upgrade of the rating is likely to follow once the final political hurdles of this rescue plan have been taken. Now, the all-important question, of course, then is what does all of this mean for sovereign bond spreads? And well, as you can see here, we've already seen quite some convergence of European bond spreads. For instance, of Italy, the gray line, with Germany, the yellow line, or the EU itself, which is the black line. And once the final political hurdles of the EU plans have been taken, so once the individual member states have all approved the rescue package, then probably this is as good as it gets. We see more tightening potential in the 10-year spread down to levels like 125. However, the longer-term political problems will probably not be resolved as easily, and therefore we're expecting spreads then sometime next year to re-widen from there. Now with this, I'm through with my slides, and I would now like to actually open the question and answer session with the audience, but as we don't have an audience here, obviously, I'm glad that my colleague Victoria has collected the most frequently asked questions that we have received on that subject.
Some are saying the EU plans will finally create the EU safe asset that many have been calling for years. Do you think this will create a competition to bonds as key benchmark in the European bond market?
Well, the EU will definitely become a major player in the European bond markets. We've seen the issuance sizes are comparable with the large established sovereign issuers out there. But to reach the 750 billion, to build a liquid curve across all maturities, this does take time. During this time, the EU will definitely make also difference to the price references, especially versus its peers like the semi-core or the other SSA issuers or covered bonds. But I don't think that it will be so much a competition to really the super core bond markets like German bonds. Also keeping in mind, by the way, that EU debt is still perceived to be temporary, i.e. the plans still have it that it will all be repaid by 2058.
So, extraordinary EU borrowing is supposed to be temporary. Last month, however, the German finance minister called the plans real progress that cannot be reversed. How do you see prospects of this borrowing facility to actually become a permanent feature for the EU?
Well, certainly a lot of people would like to see the EU become a permanent issuer in European bond markets. However, we should not forget that the EU is actually legally not allowed to have any debt according to the EU treaty. So all the debt that is out there or that will now be created is due to some exceptions that the EU treaty does allow, but first the EU treaty would have to be changed. Having said this, however, these plans set a precedent, and therefore, should the next crisis hit, I'm pretty sure that also these plans will be prolonged, and therefore we also think that the EU will become a permanent feature in the European bond markets.
You have illustrated the significant funding relief that Italy is likely to get from the EU. Would you consider the EU plans as a game changer for Italy's debt?
No, I think the funding relief is very significant, but as long as the debt load is not being reduced significantly, or as long as the support mechanisms now being put in place are not permanent, investors will still always worry about the political risks and the longer-term breakup risks of the EU, and therefore certain spread premiums will still apply. Well, thank you, Victoria, for those questions, and thank you, ladies and gentlemen, for your attention.